Paying off debt feels like crossing a finish line. But here's the thing. Reaching a zero balance isn't the end of the race. It's really the starting line for a whole new one. Today, we're going to dig into why becoming debt-free isn't just about the numbers. It's about a fundamental shift in your future, your opportunities, and believe it or not, even your health. All right, so to really get this, let's meet two people. On the left, we've got Diana. She's 34, makes $67,000 a year, and, from the outside looking in, she's doing great. On the right, that's Daniel. He's 43, with a pretty similar income of $71,000. But here's the critical difference. Daniel made his last consumer debt payment 3 years ago. Diana, well, she's still making hers every single month.
So that brings us to the big question here. How is it possible for two people with almost identical paychecks to be on paths that lead to completely different financial worlds? Well, the answer's kind of hiding in plain sight, in the money that's leaving their bank accounts each month.
Okay, let's really dig into Deanna's situation. We're going to peel back the layers here to understand not just what her debt is, but what it's truly costing her in terms of her future.
So, check this out. Take a look at her biggest debt payment. She sends $520 a month to her credit cards. Sounds responsible, right? But look closer. A whopping $380 of that, it's just interest. That means she's paying almost $400 a month just for the privilege of staying in debt, barely even touching the amount she actually owes.
And when you add it all up, the credit cards, the student loans, the car, Diana's total monthly debt payments come to $1,217. I mean, just let that sink in for a second. That's over $1,200 that can't be invested, can't grow her wealth, can't do a single thing for her future. It's just gone. And get this, if she just keeps going down this road over the life of her current loans, Diana will pay a grand total of $26,100 in interest alone. That's not the money she borrowed, that's just the fee for borrowing it. 26 grand is enough to kickstart a retirement account, help with a down payment, or launch a side hustle. Instead, poof, it just vanishes.
So this gets to a really critical idea. We have to reframe what this cost is. It's not just an interest rate. It's what we can call the debt tax. Think of it as the huge future value you're giving up every single month because you're sending money to a lender instead of into an investment. And you know what the scariest part is? It's invisible, it's permanent, and it's compounding against you. So what's the real price tag on her debt? The true cost? Well, if Diana could take that same $1,217 a month and invest it, earning a pretty standard market return, in 20 years it could grow to over $716,000. This isn't some future she's missing out on. It's a future she is actively giving away, piece by piece, month after month. That is the real cost.
But listen, this isn't all bad news. Not at all. This is a story about a pivot. So now let's turn to Daniel, because his story shows exactly how you can take this powerful financial force from a headwind that's holding you back into a tailwind that's pushing you forward. Daniel used something called the debt avalanche. It's actually pretty simple, but it is so powerful. You just list all your debts by interest rate and you attack the highest one first. For him, it was those killer 24% credit cards. Once that's paid off, you take the money you were paying on it and you stack it right on top of the next debt. It creates this awesome cash snowball that just crushes your debts way faster. Now, this is key. The second that last debt was paid off, Daniel didn't just let that extra cash disappear into his budget. No way. He had a plan. First up, he rebuilt his emergency fund to give himself a safety net. Then, he bumped up his 401k contribution to get his full company match. That's literally free money. After that, he maxed out his Roth IRA, and then every dollar left over went straight into a brokerage account. He gave every single dollar a job. And the result of all this? Well, by simply redirecting his old debt payments into investments, Daniel was now on a path to have over $650,000 in 20 years. He didn't win the lottery, he didn't get a huge promotion, he just turned the fire hose of his cash flow away from the past and pointed it directly at his future. The same compound interest that was his enemy is now his absolute best friend. But this whole thing goes way deeper than just the money. The impact of becoming debt-free, it's huge. It affects your mental health, your ability to think clearly, and even the career choices you make. There was this huge study that found something pretty amazing. Among the people they studied, the number showing clinical symptoms of anxiety dropped by 25 percentage points after they got out of debt.
This isn't just about feeling better. It's a massive, measurable improvement in well-being.
And there's a really good reason for that. Your brain doesn't just see debt as a number on a statement. It sees it as a constant, low-level threat. And dealing with that threat, even in the back of your mind, eats up your mental energy. When that threat is finally gone, it's like freeing up a ton of bandwidth for better planning, creative thinking, and just making smarter decisions.
And this isn't just theory, right? It has huge, real-world consequences. Every career move Diana thinks about has to pass through one filter. Can I still make my payments? This holds her back. Daniel, on the other hand, since he doesn't have that ball and chain, was able to take a job with the same salary but way more potential upside through equity, a risk he never could have taken before. Freedom creates options.
So look, the gap between Diana and Daniel, it's not about destiny. It's about a process. And it's a process anyone can start. So here it is, a clear 3-step playbook to build your own bridge from where you are to where you want to be. All right, step 1, you've got to pick your weapon. You've got the debt avalanche, hitting the highest interest rate first. Mathematically, this saves you the most money. Then you've got the debt snowball, knocking out the smallest balance first. This gives you these quick psychological wins that build momentum. Look, the best method, it's the one you'll actually stick to, period. Step 2, find that extra payment. Even if it's small, the acceleration is just incredible. Just an extra $200 a month on Diana's high-interest credit cards would save her $15,000 in interest and shave 6 years off her payoff time, just from finding $200. It's a game changer. And last but definitely not least, step 3. You have to know exactly where your money is going the day that last payment is made. You have to tell your money where to go before it shows up. Otherwise, it's just going to disappear into lifestyle upgrades. Follow the plan, emergency fund, 401k match, Roth IRA, and so on. Be deliberate. So at the end of the day, the real difference between Diana and Daniel isn't their income, it's not their intelligence, and it's not luck. It all comes down to the presence or the absence of a big monthly payment that's dedicated to servicing the past instead of building the future. And here's the crazy thing about that gap. It doesn't just grow, it accelerates. By year 10, the difference between them is already around $200,000. By year 20, it's over $500,000. That is the unbelievable power of compounding, and it's why every single month truly matters. So I want to leave you with this one question. You probably know what your debt balance is right now, to the penny. But have you ever actually calculated the 20-year cost of that balance? I want you to really run the numbers, not just what you owe, but what you're giving up. Because the people who close that gap the fastest, they're the ones who truly understand what staying in debt is actually costing them.